Hello, welcome back. In this video we're continuing with the sovereign issuers credit risk theme, and although this video is called non-sovereign credit risk, it's actually very much sovereign related. We're going to talk about debt issued by agencies that are government sponsored, supranational issuers, regional governments, that kind of thing. So very much still on the sort of government or sovereign linked theme, although the title of this video and the title of the relevant section in the curriculum is non-sovereign credit risk. So there's going to be a lot of repetition in this video from our previous general overview of bonds and bond issuers. We kind of did talk about them a bit in earlier on content. So, once again, one of those videos where you just probably need to watch it once and that will be good enough. Right, let's start off with agencies. We're going to go through agencies. We're going to go through the different non-sovereign issuers. What is it that agencies do? Well, the agencies we care about here, they carry out government-sponsored missions. That sounds very lofty, right? Government-sponsored missions, but various tasks which are government-led, government-sponsored, and they'll carry out a government-sponsored mission to provide some kind of public service, typically to provide public services. A good example of an agency like this would be the government. Ginnie Mae, the Government National Mortgage Association, I believe it's something like that. Ginnie Mae is government sponsored and it's supposed to provide services in the mortgage market to issue mortgage-backed securities, which help, of course, grow the American mortgage market indeed. Now, in order to perform those tasks, they may issue debt to fund these activities, and they are quasi-government entities. So even though they are not the official government or part of the government complex, they are deemed to be very much part of it, and that entails either an explicit government guarantee or a high likelihood of potentially government support in case of trouble. Because of that, they are typically given the same rating as the government itself by rating agencies. Because they either enjoy explicit or implicit backing, sort of perceived backing from the government. Now, so that's agencies, very nice and simple here. The second one is going to be government banks and development financing institutions. So government sort of sponsored banks, and in some countries you will find banks that are funded by the government and run by the government from sort of 100%. Sometimes the government may operate and fund certain specific development financing institutions. Sometimes they're called agencies, development financing institutions. And once again, they are government sponsored. They promote specific objectives. For example, giving loans to companies in specific sectors like, I don't know, agriculture or to develop, so to give loans to companies which are representatives of the sector in which the government wants to promote growth. So promote specific objectives, maybe the transition to a greener economy, that kind of thing, objectives. And once again, because they are supported by the government, in terms of them being an issuer, they enjoy the same rating typically as the government itself, receive the same or at least similar rating as the government itself. Okay, now the next one is going to be supranational issuers, such as the World Bank, for example, which we talked about before. International Monetary Fund is another one. As we, I believe, mentioned before, they are established, so created, but also owned by the member nations, so by the sovereign governments. And the whole purpose is to pursue specific objectives, such as, the eradication of poverty in developing nations, or the promotion of free trade, or some other cause deemed to be worthy. Specific common objectives, shared objectives, and of course they will issue debt to fund projects such as development projects funded by the World Bank. Okay, your curriculum doesn't actually go into any notions of any ideas of credit risk assessment here. Right, just repeats what was said before about supranational issuers. Right, and the biggest section of this reading, or this lesson in the reading, is about regional government issuers. But once again, repeating some of the points that we saw being made before. Regional government issuers. This could be cities, this could be states, this could be, whatever unit of administration exists in a given country, right? A province, for example, they will issue, well, sometimes they don't, but often they issue local authority bonds, local government bonds, which in the United States is often called municipal bonds. So local authority and municipal bonds are synonyms. They absolutely mean the same thing. And one thing you've got to be aware of is that potentially different systems or different regimes exist across different countries, across different jurisdictions. In some countries, the issuance of bonds for local government needs is going to be centralized. And there will be, this will be centralized on a federal local government basis, and therefore the rating enjoyed by those bonds is going to be similar to that of the government. In other countries, the funding of local government comes from federal taxes, which are shared between the different provinces, the different local authorities. But, for example, in the United States, you're going to see that every local issuer, a city, a state, a province, whatever local government, gets its own independent rating. That actually also exists where I come from. Every issuer has their own rating given by rating agencies because they are independent of one another. Now, municipal issuers issue essentially two types of bonds, which your curriculum goes on about, and we mentioned them before. So, two types of actual bonds, debt securities. One is the general obligation bond, and the second is the revenue bond. So, general obligation or GO bonds, and the second is revenue bonds. Now we've mentioned these before, so now it's going a little bit more. We're going a little bit more in depth. General obligation or GO bonds. What these are about is they're going to typically be unsecured, okay, and they're backed by the general revenues, the overall revenues of the issuer. So, of course, the issuer here is some kind of local authority. And when we say general revenue, well, it's typically the ability to raise taxes, to collect taxes. So they're going to be supported by the taxation authority of the issuer. Of course, in some countries you also get money from the central government allocated to you, etc., etc. And they're going to be typically used for financing specific projects. Or they will be issued, and the money from that issue will be used to finance specific projects. So, if you think about the credit analysis aspect of all this, how, if you are an analyst and you're thinking, okay, how safe are these bonds? How likely is it that the borrower will be able to repay me? Well, this is very similar to what you would do with a sovereign issuer, similar to sovereign analysis, to country analysis, but you're doing this on a smaller case now. So you'll be thinking about, I'm not going to really write this down because I think this is enough just to say similar to sovereign analysis. You'll be thinking about how attractive is the local business situation, the sort of the local business climate. What big employers, what big companies are present in a given location, in a given jurisdiction? What is the presence of industry? How diversified is that industry? Is it all one representatives of just one industry, which may be, once again, subject to fluctuations of price and demand? Or is it more diversified? Is it just production, or maybe there are services? You want a nice diversified corporate tax base, and with that typically also comes a nice personal tax base as well. So that's looking at the income side of things. How is the local government going to raise taxes, and you want a nice diversified stable corporate tax base. You also want to see the management of the budget, the local budget. What policies, how effective that management is, how disciplined it is, etc. And you'll also, not to be overlooked, be looking for signs of potential national government support, whether the national government is willing to lend a hand in times of trouble. This could be very implicit support, but if a government has let's say the central government has a history of supporting local governments in times of trouble, that will definitely be quite attractive. So maybe let me just write a few of these down, because I think that they can be tested quite easily. So things like attractiveness of local business climate. Some places are just better at attracting businesses. Presence of specific industries, including large employers. And as you may know, a lot of the time cities or provinces go out of their way to attract big employers by providing tax incentives where that's possible. Okay, you want a diversified, stable corporate tax base. And of course, as I said, with big employers come also potentially employees who may want to relocate, and they'll have to pay taxes locally as well. Prudent management of the state or local budget, prudent budget management. See where the money is being spent. And you want to look for signs of either explicit or more probably implicit national government support. In times of trouble. Please, however, remember that whilst local governments do have a say on local taxes, they've got no control over national economic policy, national monetary policy, so certain things that may impact the business climate are simply out of reach for them. They've got no authority there, so there's only a limited amount of things they can actually do, and they are heavily exposed to the same ideas as would apply with sovereign governments, things like, shifts in industrial trends, certain industries being obsolete, others emerging, and, some of the trouble with various US issuers, not just US, but US issuers specifically, like the city of Detroit, which went bankrupt, unable to service its debt, had to do with the demise of the once very powerful auto production industry in Detroit, which once again is not necessarily Detroit's fault. It's more a reflection of general macroeconomic trends happening globally. Also, demographic changes impact localities quite a lot. There's not much they can do about aging populations and maybe young people going somewhere else to live, although there is, they can do things to retain or attract new young workers. Okay, now the other type of bond, because what we just discussed was relevant to general obligation or GO bonds, the other type of bond is the revenue bond. So revenue bonds, okay, and these are issued to, once again, finance very specific projects, a specific project. And the problem with these is the investors will typically get paid out of cash flows generated by that project. So we would say that they involve or they entail a higher risk, credit risk, than general obligation bonds. Why? Well, because you're getting repaid as an investor using project cash flows from that project. Repaid using project cash flows. Okay, so what you effectively have to do is the analyst must, as a result, as a consequence, must analyze the project itself. Don't necessarily focus only on analyzing the overall condition of the issuer, but what is the money going into, because it's the cash flows generated by that project which will provide the money for payment of interest and principal repayment. So in that way, it's going to be very similar to what you would do with corporate bonds, where you analyze the company, focus on cash flow. Focus on liquidity. Focus on capital structure. All the things you would do if you were analyzing a company. And some ideas over here. Your book says, well, very often we look at the debt service coverage ratio, although, that's just one of the metrics. Debt service coverage ratio, the DSCR. Now, in reality, there are different ways to calculate this, and this is often used by banks in corporate credit analysis. But your book says, oh, this is the ratio of revenue available. And when they say revenue available, it's revenue available to make those interest and principal payments. So after various operating expenses, what's the revenue available after we've covered our operating consequences? And we take this and we relate it to the debt service. Debt service is basically the principal repayments that one needs to make plus the interest payments that one needs to make. So how much funds are available in relation to what needs to be paid. And of course, if you've got a higher debt service coverage ratio, so there is more revenue available in relation to the amounts you have to pay, that means lower risk. Okay, risk goes down. And your book says that the debt service coverage ratio itself, it's often one of the provisions, it often features in project bond covenants. So not project bonds, revenue bonds covenants. So sorry, I wrote project bond because I was thinking about the projects those bonds finance, but I really meant revenue bond covenants. So investors want this debt service coverage ratio to be maintained at an adequately high level. If it doesn't get maintained, then covenant provisions kick in and trigger some form of action, be that an increase in the spread, in the coupon, or something more drastic. And one additional point is, even though these revenue bonds are funded or are repaid using cash flows from projects, they typically also contain some provisions for secondary repayment sources, and analysts absolutely must understand those sources of secondary potential repayment. So must also appreciate or comprehend the secondary repayment sources, as I said. And that's, of course, in case the project cash flows prove to be inadequate, are not enough. Very often there may be something additional there, maybe a guarantee, a government guarantee for that project. Well, maybe there will be nothing, right? I'm not saying that there will always be, but if there are, take those into account, because they provide some kind of fallback mechanism in case things go the wrong way. So absolutely critical to appreciate and understand those secondary sources if applicable.